Welcome back, everybody, to episode 3 of the Foxy Accounting Minutes. Today, we're going to be decoding financial statements. Most of the time when people hear financial statements, all they think of is like banking and accountants, and they don't really think that there's a value in them. Well, today we're going to change that opinion. We're going to go step by step through the major financial statements you'll need, and I'll explain how it benefits you. We're going to start off with the profit and loss statement, also called income statements. Think of this one as your current standing. This is only what you brought in and what you've spent for this year. It is not cumulative. At the end of the year, all accounts go back to zero. So when you're pulling this statement, it's going to be for whatever year you're in. So if you have a January to December, you would pull it for January to December. Though some companies do off years like October to September. So you would pull it for those. The P&L is going to be your best way of tracking your income and expenses and making it so that you get the information to make decisions on a day-to-day basis. This is also the one that you really want to pay attention to at the end of the month. When we do what they call month end after you do your bank reconciliations, this is the report you really want to dig deep into and see the changes between last month and this month. So we're going to break this down. A P&L is broken down into several parts. The first one is going to be revenue or income. This is all the money that you brought in for your business. Now, there can be different sources of income for this, but in this particular section, it's just going to be your business income. You're also going to see an income section at the bottom, but that's normally for other income, such as investments and such as that. It's important to monitor your revenue stream. This is where you're going to see where you're getting the most bang for your buck. If you're selling services, which services need work that you're not selling as much of? Are you in the right price bracket here? Are you charging enough? These are the things that you will see inside of the income. I want you to think of cost of goods sold as, do I need this expense to sell my service or product? Can you sell your service or product without this expense? If you were doing retail, it would be your labor, the cost of your materials, your inventory, the cost associated with that. For retail, it would be the inventory after you sold it. We'll get back to you on inventory when we get over to the balance sheet. But for now, it's everything that it took to make the sale happen. Cost of goods sold is going to be your direct costs associated with your income. So that's going to be everything it takes to actually sell the service or the product. It's important to monitor this because this shows how efficient you are. If you sell something for $5 and it costs $6, you're not very efficient. You're actually losing money. If you sell something for $5 and it's $1, you're gaining $4. The next section is your operating expenses. This is where all of your admin, your rent, your insurance, your power bill, all of that stuff's going to go in there. And this is where a lot of your payroll is going to go because if it's not directly related to the actual service or product, it's not going to go into cost of goods sold. So your receptionist, your secretary, that's going to go in admin. And actually, you're going into admin too, even if you actually do the service. The next thing you're going to see on your profit and loss is your operating income. That is your revenue minus your cost of goods sold and minus your operating expenses. This is what we like to call your profit. This is what you made after all of your expenses. The next line is going to be the other income and expenses. This is what we were talking about earlier. This is income that you have gotten outside of your regular business. So if you sell service, it would be like the interest that you gained off an investment. You only want to put stuff that's not related to your normal business practice in here. Then your bottom line is going to be your net income. This is everything wrapped up in a nice little bow, your income minus your expenses for the whole business. This is also pre-tax. So because you use the P&L for your tax return, you're not going to put taxes until you actually file the taxes, and then you will make a journal entry then. Net income is the main number that your external sources are going to look at to see how good you are doing. You want to pay attention to this number. You want to compare it month over month, last year to this year. This gives you a good idea of how well or if there's need for improvement. Our next financial statement is our balance sheet. I want you to think of a balance sheet as long-term, over an extended period of time. This is going to give you a cumulative view of what your business looks like. The key components of a balance sheet are your assets, liabilities, equity. The first thing is your assets. So that's going to be your bank account, all of your assets or like equipment, machinery, desk, stuff like that. In here, you're also going to have prepaid. So if you paid your insurance at the beginning of the year, then you would put that here. The next section is going to be your liabilities and equity. These are put together. The liabilities are what you owe. So when you get a loan for a car, that's where you would put there. Also, if you earned money without doing the service, so if somebody prepaid, that's where you would put this as well, because that's a liability to you because you still owe the service. The equity portion is basically your ownership stake for the owners in the business. So this is all of your ins and outs. If you add money to the company, it'll go here. If you take money away, it will go here. This is also where your net income comes in at the end of the year. And this way you have a cumulative idea of how much your company is worth. It's a good idea to keep track of your balance sheet. You want to see the percentage of your liabilities versus your assets. You don't want to be in a place where you owe more than you have in assets. So it's important to keep track of that. Our last statement is a cash flow statement. This is basically a statement that shows you money coming in and money coming out. Instead of being inside of each one of the accounts, you get as it came in and as it left. The best way to think of a cash flow statement is this is a good indicator of your liquidity, and your liquidity is how much cash you have on hand. All three of these statements tell you a different story. You want to keep up with all of them, but altogether, it's going to tell you the story of your business. It's going to tell you if you're profitable, if you're stable, and do you have the ability to get cash when you need it. These are all very important things that your customers want to see, and also any other external factors such as loans, stakeholders, and if you have business partners. Keeping clean books makes it so that it's easy for you to pull these, and it makes it so that you can use these to make educated decisions for your business. So I would strongly suggest that you go into your accounting software and take a look at these statements. How are yours coming out? Where is your income? Where are your expenses? Do you have a good liquidity? This will help you to make sure that as you're doing your day-to-day business, that you'll be able to make very good decisions that are based on your actual numbers. Thank you, everyone, for joining us on this episode of Foxy Accounting Minutes. I hope you enjoyed the show and learned something today. If you found this educational, please make sure to subscribe, like, or leave a comment. And until next time, I'm LaVonna Garvin with Garvin Accounting Solutions.